So we have company A is a Zambian mid-sized manufacturing firm listed on the Lusaka Securities Exchange, LUSE. It is considering an expansion of its production capacity and wants to address the cost of financing from various sources. Below is an extract from its balance sheet. Okay, so here we have ordinary shares. This is the money raised from selling ordinary shares, 2 million kwacha. As you can see here, there are 3 zeros there. So 2 million kwacha has been raised from selling ordinary shares. This 15 web par value, this is how much the shares were sold for when they were issued. We've got 12% loan notes. Okay, this is debt, 1,500,000. This 4% is the interest rate for these loans. 8% preference shares, 1 kwacha par value, 500,000. So 500,000 was raised from selling these shares at 1 kwacha. Alright. Then we've got additional information. The company's equity beta is 1.2. So remember, equity beta, this is a measure of risk in relation to the stock market for a company. Government bonds in Zambia yield 6%, used as the risk-free rate. Yes, the risk-free rate is the interest rate on government securities. Market risk premium is 7%. Okay, so as I said earlier, on risk premium, this is the additional or extra return that you get when you invest in riskier securities. Okay. The company's loan notes are trading at 106 kwacha per 100 kwacha nominal. This 100 kwacha is the par value. This is what is paid to you when the debt matures. So this debt, you're buying it at 106 kwacha per loan note. Okay. And the before tax cost of debt is 10%. So this is the cost of debt financing before you account for tax. The preference shares trade at 0.92 kwacha per share. Right, so this is how much the preference shares for company A are going for on the securities exchange. The current market price per ordinary share is 1.25 kwacha. So this is how much the ordinary shares are going for. The corporate tax rate is 30%. So calculate the firm's weighted average cost of capital. Explain briefly the significance of work for the company's investment decision. So as I said, the weighted average cost of capital is the overall cost of financing for a company. Okay, colleagues, the overall cost of financing. Okay. So as I said, there are steps that we need to do when calculating the weighted average cost of capital. Step 1, you calculate the market values of equity and debt. So the market value of equity, this is the worth of the company's equity according to the stock market. Okay, it's the current value basically. These market values are the current values. The book values are the historical values. Okay, so the market value of equity is how much the company's equity is worth currently. So how you get this market value of equity? It's the number of ordinary shares multiplied by the market price of the equity. So in this question, they haven't given us how many ordinary shares we have. So we need to calculate the number of ordinary shares. So in order to get the number of ordinary shares, it's just the ordinary share capital, which is the money that was used to raise. This was the money that was raised from selling ordinary shares, divided by the par value of the shares. Okay. So according to our balance sheet, the ordinary share capital was 2 million. The par value of the shares, 15 ngwe. 15 ngwe, you just divide it by 100, you get 0.5 kwacha. So 200,000 divided by 0.5, you get 400,000 shares, ordinary shares. So company A sold 400,000 shares at 15 ngwe per share and made 2 million kwacha. Any questions? That's the market value of equity. Oh, we just found the ordinary shares, we haven't found the market value yet. But any questions so far? So we found the number of ordinary shares. Yes. Today I'm making sure I am recording. Okay. I'm recording. Okay. So once you find the number of ordinary shares, you just multiply it by the market price. Okay. So say the market value of equity, 400,000 shares multiplied by 1.25 kwacha per share. Because this is how much these shares for company A are going for currently. Okay. Yes. So 400,000 times 1.25, you get 5 million kwacha. So this is the value of the company's equity. Remember, equity is just the owner's stake, ownership. Okay. Yeah, this is the value of the company's market value of the equity, 500,000. Yes. Any questions before we get the market value of the preference shares and the debt? Okay, so these things just follow the same format. Okay, colleagues, once you've mastered one, then you've mastered all of them. Okay, so like for debt, okay, the market value of debt is just the number of loan notes multiplied by the market price of these loan notes. Okay, that's how we calculate the market value of debt. What is the company? What is the worth of the company's debt according to the stock market? Okay, so number of loan notes times the market price. We do not have the exact number of loan notes this company has. So to get the number of loan notes, it's just the value of the loan notes on the balance sheet. Okay, divided by the par value. In our balance sheet, they told us the loan notes are, the value of the loan notes is 1,500,000. The par value, this 100 kwacha, if you remember here, it says company's loan notes are trading at 106 per 100 kwacha. Okay, so that's the par value. That's how much you'll be paid when these loan notes mature. Okay, so it's a 1,500,000 divided by 100 kwacha, get 15,000 loan notes. Then the market value, the number of loan notes times the market price. So 15,000 notes times 106 kwacha per note, you get 1,590,000. Any questions? Even with preference shares, okay? Get the market value of the preference shares. It's the number of preference shares multiplied by the market price. So I hope we've seen the trend here with these formulae. Is the number of what the security times the market price of the security. And how you get the number of items the security has, you just get the value on the balance sheet divided by the par value. Then you multiply by the market price. So we have to get the number of preference shares. So it's the preference share capital, which is on the balance sheet, divided by the par value. So according to the balance sheet, the preference share capital 500,000, the par value 1 kwacha. So 500,000 divided by 1, 500,000 preference shares. Then to get the market value, it's the number of preference shares times the market price. So 500,000 preference shares times 0.92 kwacha per share. Okay, remember all of this information is given, okay? So 500,000 times 0.92, 460,000 kwacha. Any questions? That is step 1. Okay, that is step 1. If you want to find the total value of the company, if you want to say, okay, how much is this company worth? You just add the market value of equity, market value of debt, market value of preference shares. And that's like, that gives you like, this is the value of the company. Okay. So in company valuation, you'll see this is how we can value a company on equity or debt. So any questions, colleagues? Okay. So usually what I advise is after calculate the market values, I also advise you get the weightages, okay? Because I forgot to write the formula for WACC. But in the formula you have to put in the weightages. So to save up time in the exam, once you calculate these market values, just calculate the weightages. Okay. So we've got equity, $5 million. Okay. I'm just using these values here to get the weightages. First, you total them up. 5 million plus 1,590,000 plus 460. This is the value of this company, 7,050,000. Okay. And this is basically also the total money that was raised. D put here 1,590,000. P 160,000. So colleagues, this is also brings about the topic of the concept of capital structure. Capital structure, let's try to find out of your total financing, what percentage is equity, what percentage is debt, what percentage is preference shares. That is what that's what capital structure is. So here, basically, we're going to see this capital structure of company A. Okay. These weightages represent also the capital structure. So here total 7,050,000. So we get the weightages now. Okay. So out of this 7,050,000, what percentage is equity? You say 500,000, 5 million divided by 7,050,000. What do we get, colleagues? Five million divided by 7,050,000.
0.709.
0.709. Okay, which is 70.9%. I think if we can leave it to, let me see in my answer what okay. 1 million. So out of this 7,050,000, 70.9% is ordinary share capital, okay, or equity. 1 million 590 divided by 7,050,000. Okay, so 22.6% is debt financing. Then 460,000 divided by 7,050,000. Or to get an accurate figure, just add these two and subtract them from 1, because these weightages have to represent 100%. Okay. So I can just say let's see. 0.065. Yes. So remember, these, when you add them up, they have to equal to 1 or 100%. Okay. So 6.5% is read from preference shares. 6.5% of this amount is represented by the preference shares or preference share capital. So these are the weightages. By the time we reach our formula, we're just going to put these figures, okay? Because you don't want to start putting these figures in the, you'll see when once we reach the formula. Okay. So that's basically step 1, market values of equity, debt, and preference shares. We go to step 2. Oh, before we go to step 2, any questions? Are we okay with step 1? Okay, we go to step 2. Now we calculate the costs of each component. Cost of equity, cost of debt, cost of preference shares. Okay, so now this is where work becomes a problem for a lot of students, because you have to read carefully to see which method you're going to use. Like for cost of equity, There are two methods. Okay, two methods. There's the dividend valuation growth model and the capital asset pricing model. Okay, so you have to look at the information in your question to know which one you're using. If they mention anything about dividends, growth rate of a dividend, or a dividend getting paid, then you know for your cost of equity or the cost of equity financing, you're going to use the dividend valuation growth model. If in the question you just say dividend has been paid, or the dividend is expected to be paid, or the dividend has a growth rate, you know you're using the dividend valuation growth model. Now if a question mentions beta, equity beta, market risk premium, risk-free rate, you know you're using, could you kindly mute your mic? You know you're using the capital asset pricing model. If they just see this information, beta, especially beta, you see beta there, just know that, oh, I'm using capital asset pricing model. So in this case, to calculate the cost of equity, I'm going to use the capital asset pricing model. So remember, capital asset pricing model is just telling us for you to get higher returns, you need to incur higher risk which is measured with this beta here. The higher this beta, the higher the return you're going to get. So I'm going to say risk-free rate 6% plus the equity beta 1.2, then the market risk premium, okay, 7%. Okay, if they give you a risk premium, market risk premium, equity premium, then this subtraction you don't need to do, it's already been done for you. Okay, so that's what I've seen. RA minus RF, we've already put 7% because the subtraction has been done for you. So we calculate 1.2 times 7, 8.4%, plus 6%, 14.4%. That is the cost of equity for this company. Or think of it as the cost of equity financing. Now that's this is the return on market. Okay, RM is the return on market, or the average return on market. This just tells you the average return you expect to get if you invest in a certain stock market. Okay, so if we say the return on market for the Lusaka Securities Exchange is 5%, it means if you invest in the Osaka Securities Exchange, on average expect to get a return of 5%. Okay, most companies that are there give you returns which are near that 5% or close to that. Okay, so this cost of equity is the cost of equity financing to company A. Now when we look at it from the investor's perspective, this is the minimum required return to make the shareholder happy. Forgot to mention to you, WACC, you're always going to look at it on two angles: the company's angle and the investor's angle. So WACC on the company's angle is the overall cost of financing. On the investor's angle, that's the minimum required rate of return to make the investor happy. Okay, so to the company side, it's a cost. To the investor side, it is a return. Yes. Any questions? Okay, the cost of debt here, at least whoever wrote this test was lucky, because cost of debt, especially if it's a redeemable debt, you have to use the internal rate of return. Okay, because debt, when you're dealing with the costs, it's either the debt is redeemable or it's irredeemable. The question will mention to you, they will tell you when the debt is mature. If they tell you a date when the debt is maturing, it's redeemable. That means you have to use the internal rate of return. Okay, here in this case, did they say when the debt matures? I don't think they mentioned when the debt matures. So if they don't mention anything when the debt is maturing, then you know you're dealing with irredeemable debt. Irredeemable debt is just a small formula that you have to use. Now in this question, they've already calculated for you the before tax cost of debt, which is 10%. So all that you need to calculate is the after tax cost of debt. Okay. So here at least you didn't have to use the internal rate of return to get the debt, cost of debt, and you didn't have to use the other formula. Okay, they have just been given a before tax cost of debt. So when you're given a before tax cost of debt, you just get the after tax cost of debt. So you get it. It's the cost of debt multiplied by yes. Okay. So that we can get our after tax cost of debt. So the before tax cost of debt 10% multiplied by 1 minus the tax rate. The tax rate was 30%. Okay, 30%. So that 30% converted into a decimal, since it's a 1 here minus, so you can say 1 minus 30%. So convert it into a decimal, 0.3. 0.3, 1 minus 0.3, 0.7. 0.7 times 10, 7%. So this is the after tax cost of debt. Any questions? Okay, so when my energy levels are going to be at 100%, I'll explain to you about this after tax cost of debt and why debt, when you incur debt, you actually save on taxes. Okay, you actually save on taxes when you incur debt. So I will illustrate to you all of that probably in our next lesson. Yes, but any questions here? This is our cost of debt, 7% after tax cost of debt. For preference shares, cost of preference shares, at least for it, it's very easy. It's the dividend for the preference shares divided by the market price for the preference shares. Okay, that's the cost of preference shares. The dividend per preference share divided by the market price per preference share. Okay. So the total of the preference shares, if you remember in the question here, it said 8% preference shares. So you just get 8% of the par value to find out how much dividends the preference shareholders are getting. So just say 8% of 1 kwacha, the preference shareholders are getting 8 ngwe as a dividend. Colleagues, what can you do with an 8 ngwe? Because you find this, if you're owning one preference share, this is how much you're getting. 8 ngwe. You don't have any voting rights. Okay. If the company closes, they'll pay you your 8 ngwe before they pay the ordinary shareholder. You'll get your 8 ngwe before the. But what can you do with an 8 ngwe? There's not really much you can do with an 8 ngwe. That's why to get rich off of this stuff, you have to buy more. Okay, at least have maybe 100 preference shares. At least maybe there you'll be getting 800. I think 100 times 8 ngwe. Yeah, you won't you be getting 8 kwacha? These things pay low. Colleagues, if you have 100 preference shares, you're getting 8 kwacha. That's so disappointing. Yes. So this is the cost of the preference shares. The dividend 8 ngwe. The market price 92 ngwe. So 0.08 divided by 0.92 is 0.087 or 8.7%. That's the cost of preference shares. Cost of preference share financing to the company. And to the preference shareholder, this is the minimum return that will make them happy. Any questions? These weightages were already calculated, so yeah. Any questions? So once you've got the market values and the costs, then you're set to go. Okay. So here's the formula in its original form. Wacc equals, first you do the cost of equity, KE, multiplied by the weightage of equity. So you're going to say the equity financing over the total financing. When we added equity plus debt plus preference shares. Okay, this is the weightage here. Okay.
Sir, just a minute. Where did you get the 0.92 on top here where you found the 87%?
Here, let me show you where I got it. The preference shares trade at 0.92 per share.
Okay.
Yes, so when you're dealing with this question in the exam, what our advice is, where you're solving, write down all this information so that you're not scrolling up and down. I like the way this question came, because most of these questions for work, they're in paragraphs. Okay, it's a big paragraph, 3 paragraphs. So you find at least the way it was brought here, this is a nice way. So as you're reading through the question, just underline all the numbers. Okay, underline all the numbers so that when you come to the formula, yeah, okay. Okay, plus the cost of preference shares multiplied by the weightage of the preference shares, P over E plus D plus P, plus the after-tax cost of debt KD 1 minus T multiplied by the weightage of debt D over E plus D plus B. Okay, so basically in this formula it's just the weightage times the cost. Okay, weightage times the cost. All right, so we already calculated these weightages, so you don't need to put this value over this fraction. You've already calculated it. Okay, yes, so the weightage of equity was 0.709, cost of equity 14.4%, weightage of debt 0.226, cost of debt 7%, weightage of preference shares 0.065, multiplied by the cost of preference shares 8.7%. 8.7%. You do your tabulations, and your weighted average cost of capital, which is the overall cost of financing for this company, is 12.36%. So whatever you invest in, you should make sure your returns are greater than 12%. Okay, because WACC and investment appraisal are interconnected. This weighted average cost of capital is used as your discount rate in the investment appraisal. For your net present value technique, you use this WACC as your discount rate. For the IRR, you're going to compare the return of your project against this WACC. If your IRR is less than this WACC, then don't even invest in that project. You want it greater than your weighted average cost of capital. Okay, so this weighted average cost of capital, apart from it being the overall cost of financing to the company, or the minimum required rate of return to the providers of the financing to the capital, this is also used as our discount rate and in investment appraisal. Yes, any questions?